introduce you to the Shady Spring Bank team. First, a brief synopsis of Shady Spring Bank. Shady Spring Bank is a full-service financial institution with more than 50 locations throughout the greater Washington, D.C. area. They offer business and personal loans and deposits, as well as investments, wealth management, and trust services. The key to their success is more than 155 years in making every one of their clients know their business is more important when business than their health. In their capacity as a financial services company, they work with individuals, nonprofits, small to medium-sized businesses, middle market, and large corporate clients who want a bank that is big enough to have a wide variety of sophisticated and competitive products and services, but small enough to offer outstanding personal services. Locally headquartered, every client has a banker who lives and works in our communities. So let's start off with Mr. Ian Thomas. He is the Vice President Commercial Relationships Manager. He's a proud Pittsburgh native and Virginia Tech alumni. Ian Thomas has lived in Washington, D.C. area for almost a decade, working in the financial services industry. He started his work as an analyst and worked through multiple roles before becoming a commercial leader in 2019. Mr. Thomas' background as an analyst provides him with knowledge across multiple industries, including healthcare, government contracting, commercial real estate, manufacturing, and more. Active in his community, he serves on the board as a treasurer for the Girls on the Run, Washington, D.C., a nonprofit that provides services and support for underserved youth. Mr. Alex. Mr. Alex has developed an extensive knowledge across several lines of business during his 15 years experience working in financial services, including commercial and nonprofit banking. He is a dedicated commercial relationships manager who focuses on providing strategic financial advice and solutions to help organizations grow, improve cash flow, and manage their cash management capital capabilities. Alex clients include government contractors, professional service providers, nonprofits, and many others. Now, last but not least, Mr. John Golsen. Mr. John Golsen brings over 20 years of SBA leading and leadership experience in his role as Director of Government Guaranteed Lending with Sandy Spring Bank. John oversees the bank SBA and USDA lending programs, which provide flexible financing solutions for small businesses throughout the country. Mr. Golsen graduated with an MBA from the University of Maryland and earned his Bachelor of Arts from James Madison University. He currently resides in Maryland with his wife. Now, let me introduce you to Shady Spring Bank. You can take off, Mr. Ian.
All right. Well, thank you very much for that introduction here this morning, Curtis, and thank you everybody for being on here. I'm gonna be running through a few quick slides here about the financing options that community banks can provide. Most of you are probably privy to how most of these work, so this is sort of going to be a general overview. And at the end of that, I'll give you an idea of what banks look at, what the requests are going to be while you go through the process. Some of you may not have worked with a bank before on obtaining financing, so this could be a first time through for you. So just kind of want to set expectations for what you might be looking for. So again, I'll run through, those are 5 of the primary types of financing that I provide. Lines of credit, a borrowing-based line of credit, real estate purchase or real estate acquisition financing, build-out financing, and equipment financing. Now, in addition to running through those loan types, my goal is to sort of provide a roadmap and to set your expectations of what this process looks like. Commercial deals are much more open-ended than what you might see in a typical residential mortgage. With things like that, everything fits into a box, and there are some more regulated programs that banks have to adhere to. The commercial space is a little bit more open-ended there. We we pride ourselves on coming up with creative financial solutions. I think we're aware of the fact that every business has their own story, and understanding that completely, along with the financials, gives us the full picture of what we're looking for. And I'd like you to keep in mind as we go through this, these loans are for companies at every level of the business cycle. So, and it doesn't particularly matter what industry it is in. I've seen these come up at inception, at day one of a business. I have seen it going through an exit strategy where a company is selling their company. I've seen it through growth phases, and I've seen it through stabilized periods of revenue. So, truthfully, this sort of caters to everybody here. All right, so first one I wanted to talk about is a line of credit. This one, think of this as a business credit card. So this financing helps hold over payroll, supports contracts. I mentioned here that it can be used as a rainy day fund. Back in 2020, I think everybody's world sort of blew up with COVID. And I will say that folks were able to utilize lines of credit during that weird time where you weren't sure where the next source of funds was coming from. So even if you don't have an immediate need for it, this is something that you may want on the burner just as something to look for. Now, a couple rules of thumb with this, because one of the big questions I always get from folks is, well, I ask them how much of a line of credit they're looking for, and the usual response is as much as you can give me, which I can appreciate the hustle there, but that isn't particularly how it always works. A good rule of thumb would be 10% of revenues. So if you're $1 million a year company, you're probably most apt for a $100,000 line of credit. That is not a finite rule, but it's usually somewhere in that area. Now the terms on these are 1 year, and the reason for that is because as your company grows, the line of credit typically grows with you. So we like to touch base on these once every year, see what activity looks like, see how the company's performance is going. So just know that those terms are typically renegotiated or retouched on every year. A similar structure to that is a borrowing-based line of credit. Now, the only tangible difference between this and a regular line of credit is that the loan amount here is directly calculated from your accounts receivable. The reason we do that is this is largely used in the government contracting world. So, for example, let's say you win a new contract that's going to increase your receivables up to $1 million. The bank would be able to provide financing up to a certain percentage of what your accounts receivable are. Again, this is more in line for contract heavy and proposal heavy companies. If they have a large AR that can be used as a source of collateral and as additional source of repayment. All right. The third transaction I see the most is real estate related. So this is what we would call owner-occupied financing. The difference between owner-occupied financing and, let's say, investment real estate is that your company ideally would occupy the space that you would like to purchase. There's a little bit more wiggle room with that. There would be a personal guarantee with that. The corporation would guarantee. And we could provide financing for the purchase of land, and then you want to build your own property. We could finance the purchase of an office space or a combination of the two. Maybe you want to buy a place, but you would like to improve the interior a little bit. We can help out with that. Again, with this one, the collateral on this would be the real estate itself. The loan amount would be limited to typically 80%. John will speak a little bit about some SBA programs where we can increase that percentage a little bit. But as far as traditional commercial financing goes, it's typically around 80%. The rate would be fixed, and we usually look at this one for about 5 or 10 years compared to the 1 year on the lines of credit. So with that real estate as collateral, that really gives us a little bit more comfortability there. All right. Build out financing. This is another common one. I will say this can apply to folks that are either renting office space or they own their own office space. I've seen both. So for example, I can think off the top of my head, within about a year ago, we had a company that was expanding their office space to a new location down in Woodbridge where their headquarters was in Tysons. They needed some money to get desks, laptops, chairs, things like that in the door, and we were able to provide financing on it. The collateral section of this can be a little bit up to debate. If you do own the property, sometimes banks would consider taking a second deed of trust there. If you don't own the property, it would be an increased UCC lien, or potentially cash as collateral. That's sort of up for discussion and would be dependent on the situation. The last one I have here is equipment financing. So with equipment financing, we have gotten very creative with this. I think 10 or 15 years ago, that really just meant cars, trucks, maybe some heavy machinery, equipment, things of that nature. I have a couple clients that have patented proprietary designs that we have taken liens on. So if a doctor is considering buying a new X-ray machine, the bank can finance that. If you're looking at buying a new company car, the bank can finance that. This one, the structure on this one, we would use that equipment as the collateral. The loan terms, those vary as well. Again, depends on the strength of the company, but typically somewhere between 3 and 7 years. And we'd be able to fix that rate as well. So that has the advantage of the lines of credit here. Now, look, I know I just sort of ran through most of those. I'm sure, like I said, most of you are probably aware of what some of those financing solutions are. If I was moving too quickly through it, obviously the question box will be for that as well, and I'll also provide my email at the end of this if you want to reach out personally. Now, the next step. Once you decide what loan facility you're looking to move forward with, it comes to the bank's sort of financial request. So here's a list of, sort of a general financial package of what a bank would want to look at when they're considering financing. So the biggest thing here is the business financials. That'll give us an idea of the strength of the company financially. It also gives us a financial narration as to what you've done over the last few years. Personal financials, again, all of these would include a personal guarantee on the business owner. So there is going to be a personal component to this. And then, depending on the deal, anything that's directly applicable to that deal itself. Now, this section of it is more so just sort of giving you an idea of what banks look for or what banks appreciate or what they consider while they're going through this underwriting process. So the first section there, you see the 3 C's. Character, cash flow, and collateral. That's sort of a general phrase that is used commonly throughout banking. So we do need to look at those numbers, see how that cash flow works. We do want to see what the loan is secured by, but the character part of it is another element. This is where I think community banks have such an advantage because every single one of you business owners out there have your own story. There's a different story for each and every one of you. We're cognizant of that. And maybe that story changed for 2 years, but it's going to change back. This is a conversational discussion between the bank and the business owners like yourselves. So to sort of build on that, then it goes to cash flow. This has always been a big point of discussion. You have to make sure you can cover the debt and any other debt that you may have. Deposits. This has become a heightened focus, I would say, over the last 5 to 6 years, but if you were talking with the bank about financing on something, be sure to expect you need to move your operational deposits as well. Community banks don't consider themselves transactional, meaning they want the whole relationship. I want to reiterate this is a give and take between the bank and the customer themselves. The other things we spoke on a little bit, some of you may think, well, I'm not sure if I qualify for a loan under the traditional commercial experience here. So, and whenever that does occur, banks want to work with you. So we will look at credit enhancements. For example, if a bank feels you may not qualify for a line of credit, but you have some equity in your personal residence, maybe there's a way to use that as collateral. There's ways around this. Our goal is to work with you through the growth process of growing your company. We certainly don't want to handicap anything or stop you from operations. Our role is not to tell you how to run the business. It's more so to help support it in any way that we can. But by saying that, capital is different from financing. Capital is somebody investing in the company itself for something in return. Banks are more so here to support. So please do keep that in mind as you guys are working through this. you'll encounter a lot of questions from banks, like good amount of back and forth. I have a lot of back and forth with my clients, but it's only so we can fully understand what you guys are going through, and either put you in the correct product or put you in the right spot that you need to be. Like I said, everybody's going to have a different story. So with that, I just want to say thank you for your time here. I'll provide my contact details along with Curtis here at the end, but I appreciate you all taking some time here to listen. And Curtis, I guess I'll leave it up to you. I don't know if you want to do questions now or let John keep rolling, and then we can do questions at the end. I'll leave that up to you, but appreciate everybody's time. Thanks.
We can tackle them at the end if that's fine with you.
That works for me. Well, with that, I will pass it off here to John. I know John's going to touch on some of our SBA lending. Just another resource for you if a conventional commercial route may not be your go-to plan. So, John, passing it on off to you.
Thank you, Ian. I appreciate it. And Curtis, I don't have access to the
Second,
slides.
John.
Can you advance to the first SBA slide, please?
Absolutely.
There we go. Thank you. So good morning, everybody. Appreciate your time, and Ian, great overview on the conventional product side. The SBA, the Small Business Administration, created loan programs probably about 50 or so years ago that were designed for small business owners that struggled to get qualified for conventional financing. It might be because they were a startup entity and didn't have the operating history that a bank looks for to qualify. It might have been an absence of collateral, as Ian touched on previously. Collateral is a very important consideration on the conventional lending side. So you might have a business acquisition opportunity where there's not a building involved and it's goodwill. That would be an example of a loan that doesn't have collateral. That would be one that the SBA loan programs were designed for. In terms of who qualifies for SBA loan programs, it does need to be a for-profit entity. So nonprofit entities are not eligible for those loan programs. There are size standards that determine what a small business is in terms of these programs. They are pretty high. It's annual net income average over a 2-year period of $6.5 million or less, and net worth of less than $20 million. As you can imagine, with those numbers, we very, very rarely see a company that doesn't qualify based on those size standards. The company does need to be comprised 51% or more of U.S. citizens or green card holders, and personal guarantees are required of any individuals that have a 20% or greater ownership stake in the company. So that's what the qualification profile looks like for this program. The value proposition, as Ian touched on previously, these programs do require a lower down payment, typically a 10% down payment requirement as opposed to 20% on the conventional side. And they typically provide a longer term as well. For a non-real estate transaction, they often provide a 10-year term compared to that 5-year term that Ian talked about earlier. And on real estate transactions, they typically offer a 25-year term compared to a 15 to 20-year term on the conventional side. So that longer term provides a lower monthly payment for the borrower. So those are kind of the value propositions associated with that program. There are a couple of primary products. The jack of all trades, and the one that gets used most often is the 7A program. This can be used for just about any commercial need. It can include real estate purchase opportunities, business acquisition and partner buyout opportunities, tenant improvements and leasehold improvements, working capital, equipment, inventory. Again, for the non-real estate transactions, this is going to be a 10-year term. That 10-year term is not going to have a prepayment penalty, so it's got a lot of flexibility around your ability to pay it off more quickly if you want to. The real estate transactions will have a 25-year term, and again, the expectation would be a 10% down payment and a 90% loan solution on that product. The other popular product within this SBA group is the 504 loan program. This is really designed specifically for real estate transactions and large equipment purchases. Again, the same thing, it's a 10% down payment requirement with a 90% loan solution. With regard to lines of credit, there is a product called the Express Line of Credit, and that is for opportunities that are $500,000 and less. And these do provide a both longer draw period and longer term than the conventional product does. These typically provide a 5-year draw period. And at the end of that 5-year draw period, whatever the balance is then converts to a 5-year term loan. So, typical revolving line of credit concept, flexible from the standpoint of drawing on funds when you need them, as opposed to a term loan where you get all the money up front and start paying P&I right away. From a process perspective, Sandy Spring Bank is what's called a preferred lending provider, a PLP designation within the SBA realm. That means we've done enough of these that the SBA knows that we know what we're doing, and everything is done and processed internally. We don't need to ship anything out to the SBA for their approval. So it's a very streamlined process. We communicate directly with you. Your approval is through us, and your payments are directly to us as well. So very handy product. You don't necessarily need to be a borrower that doesn't qualify for conventional financing. Certainly, if you don't, this is a viable solution. But even borrowers that qualify for conventional financing, good banks and good lenders share both the SBA solution and the conventional product solution, and let the borrower choose which one's better for them. The trade-off is the interest rates on SBA loans are a bit higher than they are on the conventional side. And again, it's just a question of whether that trade-off of a lower down payment and a longer term makes sense given that higher interest rate environment. So at a very high level, that's what the program looks like. That's what it was designed to be utilized for. We do quite a bit in this space. We do it on a national basis. We have 8 business development officers located throughout the country, including 2 here within the bank's footprint in the kind of the DC metro and Baltimore area. And everybody on the team has 20 plus years of experience. So appreciate your time, and happy to answer any questions that you guys have at the appropriate time. So thanks, Curtis. Appreciate it.
You're welcome. Thank you. Appreciate you guys. So we do have a few questions that came in. One is the 3 years of business taxes a must, or can you work with 2 years of business taxes?
I can work with 2. Yeah. If it's a new company, then obviously we can work with you. If you just started 2 years ago, yeah, absolutely. We completely understand that.
Thank you. What advantages are there with community banking versus federal credit unions? Example like Navy Federal.
Good question. I certainly, I've heard a lot of success stories from members of federal credit unions. If you do apply for a federal credit union, there's certainly advantages to that. I believe being a member can make them pretty competitive on rates from that standpoint of things. I think the difference here is, look, credit unions they're not for profit, banks are. That gives us a little bit bigger budget. We have some more resources, some more people. We're usually a little bit quicker to be updating our technology, as far as the apps go and what some of our services are. As far as, commercial lending transactions, it really comes down to who you're working with. I think commercial banks can certainly give a similar competitive rate product there. It really depends on what you're looking for. I know people have serious attachments to credit unions, and I respect that. I know they've taken care of quite a few people, and I can't say I see them on a whole lot of competing term sheets. So again, I think the size and scale of banks just give it a little bit more of a push.
And Ian, I'll just add to that on the SBA side. There are a handful of federal credit unions that provide SBA loans, but I don't see them in that space very often either, for the reasons you just mentioned. From a resource perspective, they're not often active in the SBA lending space. So from a product availability and diversity perspective, I think banks typically offer a little bit more than credit unions do in some instances.
Yeah, they're probably a tad more conservative in their analysis. With them being not-for-profit, things are looked at a little bit tighter. So I think even community banks are probably a little more adept to take on some more risk as well. So, and that can apply to whether it's startup businesses or maybe you're in a bit of a sticky situation. That can make us, we have a little bit more wiggle room there.
And Curtis, real quick, just a process check. I've seen a couple of questions pop up on the screen. Do you want to address those later, or do you want to address those as they pop up, or what's easiest?
Well, I'm trying to go in order from what I see in the chat. That's why I usually ask, could you put the question in the Q&A? I can follow it a little better, but Let me try to go through the ones that came in the chat and just scroll down, and we can just do it like that so we make sure we can answer everybody's question. The next question was, why does it, I think they was asking, why does the SBA loans have a higher interest rate?
Yeah, typically interest rates globally across the board reflect an interest premium, so or risk premium. I'm sorry. So the riskier the deal, the higher the interest rate is the short, easy solution. As you can imagine, we do have SBA borrowers that have a strong credit profile, and their interest rate would reflect that, i.e., it would be lower. But generically, because SBA loans were designed for borrowers that struggle to find conventional financing, the risk premium that was built into that interest rate was a little bit higher, and that's why interest rates have been higher in that space than on the conventional side.
Got you. Thank you. What pathway may be appropriate for financing the creation of software that will be generating revenue?
Can you repeat that for me, Curtis?
Sure. What pathway may be appropriate for financing the creation of software that will be generating revenue?
Okay, that's a good question. So if we're looking at software development here, and this is a little bit of what I touched on. This is where it may be difference between capital versus finance. This may be where if this is R&D that you're injecting into the company in order to spike that growth, typically banks need to see that growth before they can really look at financing it. What do I mean by that? Software is a tough one to put down because you can't hold it, right? Most of the banks like what we call hard collateral. That one is not necessarily hard collateral. It does give you a distinct competitive or business advantage if you're developing software that is, more efficient from somewhere else. But in that scenario, if you need, 50,000, 100,000 just for R&D to develop that, and you don't necessarily have the cash flow yet to support it, that's where you may need to look at an investor or a capital injection from the owners rather than using traditional financing.
And Curtis, if I can add to that, not necessarily related to software specifically, but for a startup entity more broadly, the SBA loan programs do facilitate financing of startup entities. Key considerations there: the quality of a business plan, the detail around that, the projections and the assumptions that go into that, all those demonstrate business acumen and how well the borrower knows that business. That's going to be a critical evaluation consideration of the bank. Industry experience, while not necessarily critical, it's very important, obviously. And if they don't have relevant industry experience, if they have business ownership experience in a different industry, but have demonstrated that they know how to run a business, that's going to be helpful as well. So those are the kinds of considerations that go into evaluating a startup opportunity. I hope that helps.
Awesome. Thank you. This one might be for you, John. Can a SBA loan also be used for hiring new employees?
It can, yes. So the 7(a) term loan specifically and the express line of credit would both be products suitable for that. Both can facilitate working capital needs. On the 7(a) term loan, if somebody gets a new product or new project awarded to them and they need to hire new staff for that, buy new computers, that type of thing, a 7(a) term loan can be used to facilitate that. An express line of credit can be as well. Again, the express line of credit would be a 5-year draw period that converts to a 5-year term loan, but both of those could be used in that situation.
Awesome. Thank you. Somebody asked, is there any advantages regarding loan approval depending on the business structure? Example, sole prop or corporation?
From my perspective, not particularly. We deal with all different types of organizational structures. Some of them more chaotic than others. Some of them are simple and clean. Some are not. It does add paperwork. I'll give you that if there are more entities involved or different individuals. Again, the one thing, and I meant to touch on this before I finished my presentation. So the one thing about most of these loan processes is if you have an owner of a business that owns 20% or more, typically they're going to be required to provide a guarantee. That is a little rule of thumb there. So in that structure, we'd have the company borrowing, and then we'd have any individual owners guaranteeing it. Sometimes if the cash flow is tight, we can add in another operating entity as a guarantor to help boost some of that cash flow. But as far as the entity structure itself, that doesn't particularly make a difference to us.
And I'll say the same on the SBA side, sole prop, partnership, S Corp, C Corp, no preference there. And again, on the SBA side specifically, it needs to be a for-profit entity. Nonprofit entities are not eligible for that program.
Awesome. Thank you. Somebody typed in process for SBA Express line of credit.
Yeah, so the process is the same, and more broadly, the process is very similar to what Ian described. We would collect from the borrower 3 years of personal tax returns, 3 years of business tax returns if they exist. Obviously, for a startup, they wouldn't have that. On the personal side, it would be a personal financial statement. On the business side, business plan and projections where relevant. So very similar. And again, most of the small business owners here have probably been through that process, but it's no different on the SBA side than it would be on the conventional side.
Awesome. Thank you, John. Do you cover multifamily?
Yes, we do. That is so. I will say, just this is a little bit of market now knowledge. Investment real estate is has been a little less activity within banks. They've been keeping a closer eye on that. So, if you have a potential multifamily play, I would get ready to tie some deposits to that. Again, I think if banks are doing investment real estate loans, they're going to want a good, 20, a good chunk of deposits that come along with that. So just sort of want to set the expectations there. But yes, absolutely, those are very popular, especially in this area.
And by comparison, the SBA loan program for real estate purchases is limited only to owner-occupied real estate transactions. Investment properties are not eligible through the SBA program.
Thank you. What are the best options for a 30-year-old small veteran-owned construction company that is struggling since COVID to get back on their feet, operating at a concerning loss but slowly making some ground, struggling to find someone to lend to us for a contract that we have in place?
Yeah. Well, look, I'll say you're not the only folks that have been struggling since COVID. I think there are quite a few people that have had a hard time getting back on their feet. So it's not an uncommon story. I think there may be a few ways around that. Obviously I can't speak to the numbers. I don't have your numbers right in front of me. It's from your perspective, if they're concerning, then it sounds like traditional bank financing may not be the route. John Golsen could be an option. A workout company could be an option. There are companies that'll, sort of private equity almost type of vibe where they will inject some capital in it based off of a contract that's supposed to provide some approvals. Their terms are a little harsher, but again, it's because they're trying to offset some of that risk. So, if it is a bad picture, certainly folks can work with you. But I can if you want to reach out to me directly on the side, I can either chat with you or provide some context in the capital space that may be able to help.
And I'll just add to that on the SBA side. Despite the program enhancements, the SBA lenders are still looking for proven ability to service the debt. And if there's not historical evidence of that, if we're going to rely on projections, we need solid information around why those projections make sense over the historic numbers, if the historic numbers exist. So again, ability to pay the loan is going to be a critical evaluation consideration and factor, whether it's an SBA loan or a conventional loan.
Gotcha. Thank you, guys. Does the SBA do microloans for new businesses? If so, what is the limits and average rate and length?
Yeah, there's a program called the Community Advantage Program designed for just such opportunities. Our bank doesn't participate in it, but we have a partner bank based in the area that does, and I often refer people to them. Those are typically 300,000 and under. We often see loan requests for amounts as little as 10,000, 15,000, 20,000 that we can't facilitate that this group can. So there's a program, again, it's called Community Advantage Program. It is an SBA sponsored loan program. Sandy Spring Bank doesn't participate in it, but we have a lending partner that does. I honestly am not that familiar with the terms of those loans because we don't provide those loans directly. But I would imagine that it's safe to set expectations around similar to what we provide in terms of loan and interest rates.
Makes sense. Thank you. Uh, would a purchase of a business rather than a partner buyout be eligible under SBA?
It would, yes. Both business acquisition and partner buyouts are eligible under SBA. Partner buyouts, it used to have to be 100% buyout. They have changed the rules recently to where it can be a partial buyout now, but both are very, very common in the SBA lending space. Again, those would typically be a 10-year term. And just to give you a sense of where interest rates are more specifically, again, it's going to vary by loan and by quality of the borrower. SBA loans on the 7A side typically run at a prime plus premium. So prime anywhere from prime plus 1 to prime plus 275. Prime is currently at 7.75, so you can do the math. By comparison, the 504 loans, which again are specifically for owner-occupied real estate, those interest rates are much lower, and they can provide a 25-year fixed rate as low as in the 6 to 6.5% range. So just to give the audience a sense of where the interest rates are for the different loan programs.
Thank you. Do these loans build business credit, as in are they reported to Duns and Bradstreet?
Yes. Yes, they do. So I'm blanking on the name of the report that we have now, but yeah, there are some general inquiries about that, primarily to make sure, you know, you're filed with the state, things of that nature, your tax transcripts line up with your returns. So all of that sort of goes into it, whether other banks are opening accounts for you. It's less intensive than a personal credit score. You know, in our underwriting and our guidelines, there's a little less emphasis on the business credit score and a lot more on the personal guarantors and on the credit scores there. But yes, we do.
Thank you. Somebody asked, how can we get loans for bids that we win? Went over that already.
Let's see. Yeah, I mean I think that sort of ties in with I see the next question from Seth there. So
Yeah.
if you guys are winning bids, again, I spoke about this before. We certainly understand that hey, not only is your workload and your revenue is going to jump based off the award of that proposal, but that means you got to staff up. That means you have to get equipment. You have to get X, Y, and Z. So our goal there is to first of all capture what your new timeline looks like. All right, does that contract start in 3 months, first payment, not for 6 months on that? You know, getting a clear understanding of that helps us to structure that. You know, I think if it's going to have that tangible of an effect on your revenues, doing projections, doing a formal projection, you know, if it's a 3-year contract, try to sync up and do a 3-year projection. If we can see, you know, if you got revenues of 50 grand now, but in a year and a half, 2 years from now, it's going to be 1.5 based off that. If we can see that, that makes it easier for us to lend on it.
Gotcha. And to piggyback off that same question that you've seen from Seth, I guess you wanted to ask, would that company pursue a 7(a) or a 504 loan? How long would it take to secure the funds, and would the contract be the collateral?
Yeah, so a couple of answers there. The 504 is no. 504 is strictly real estate and heavy equipment acquisition. 7A could be utilized for that. Express line of credit if it's under 500,000. There's actually another SBA product called the SBA cap line that mirrors what Ian talked about on the conventional side from an asset-based lending perspective. So you win a big contract and you need funding for that, there can be a cap line tied to that as well. I think part of the question was, what's the timing consideration around that? Once we have all of the information collected from the borrower, typically I would say a 2 to 3 week period for approval, oftentimes less, but we don't want to overpromise and underdeliver. And from the time we have all the documents from the borrower until closing, you're typically looking at probably 45 to 60 days total. So I hope that helps, and happy to answer any more specific questions around that.
And just a quick piggyback, you know, traditional bank financing, pretty similar. You know, John has to, I would say our underwriting timeline, once we receive all information, is usually, like he said, 30 to 45 days to get that thing to close. But, you know, a lot of external factors there too, whether it's appraisals, third-party reports, things of that nature. So.
Awesome, thank you. I've had an SBA 7(a) loan for a little over 5 years. Can I get another loan before I pay off the first one? The first loan was $150,000.
Yeah, great question. The answer is yes. Borrowers can borrow collectively up to $5 million against an SBA loan cap. So in this case, for Jose, 150,000, he's got a ton of additional runway available. You bump up against that with larger contracts. Obviously, if somebody utilizes a $5 million 7A loan program with one loan, they're going to be limited in their ability. But anybody who has loan amounts below that or well below that can secure as many additional 7A loans as long as they don't bump up against that $5 million cap.
Thank you. We are an SDV OSB specializing in providing IT solutions to the DoD. Having won several contracts as a subcontractor, we are now required to staff multiple positions. To do this, we need working capital to fund these positions up front until cash flow begins. Would an SBA 504 loan be a suitable option for this purpose? If not, what other financing solutions would you recommend?
Yeah, so the 504 loan would not be again because that is limited to real estate and heavy equipment. However, 7A loan could be utilized for that. The express line of credit could be utilized for that, and the cap line could be utilized for that. And we have similar circumstances to the one described very specifically there with borrowers that have won contracts, have staffing needs, and use those facilities to address those needs.
Awesome, thank you. I think you just answered this question, but I want to make sure I'm right. Is there an option for residential commercial capital?
Can you run that by me again?
Is there a financial option for residential and commercial capital?
So, Ian, I'll just, well, go ahead.
Yeah, I guess I guess I'm a little confused what the question is. So we do investment residential. I got some single family home builders, developers that I finance. If you've got a track record there, that's certainly something we're looking at. If you're talking about a personal mortgage, I don't specifically do that, but our bank obviously does. That's a little bit of a different process. And same goes with commercial. If you've got, if it's you're trying to buy office space as an investment, we can certainly look at it. Again, there would have to be deposits tied, things of that nature. Or if you're trying to buy office space for your company to occupy it, that ties into John's 504 program there. That's what we call it, owner occupied financing. So that's on the commercial side of things. So yes, we do that as well.
And the only thing I'll add to that, Ian, from an SBA perspective is, again, SBA loans are for owner-occupied properties. The threshold is 51%. The business has to occupy 51% or more of the property to qualify as owner-occupied. That means they can lease out the remaining 49%, or we have dealt with mixed-use properties as well, where it's a combination of commercial and residential, and the commercial component needs to be 51% or more and owner-occupied. So that may be way more detail than you need, but that's how it fits into the SBA program.
Thank you. Is there a general rule of thumb to determine the business valuation? Example, 3 or 5 years time, 3 years average revenue.
All right, so this
doesn't speak much to expertise there. I know there's depending on the industry, there's different multiples and different metrics that folks like to use. I leave that to smarter heads than myself.
So I'll take a stab at that because we deal with business valuations often on business acquisition and partner buyout opportunities. And this is very dangerous in that, take this with a grain of salt that it's worth. But generally speaking, the rule of thumb is that a business valuation comes out at a multiple of 3 to 3.5 times of the business EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. I don't know if that's a term that most of the audience is familiar with or not. It's basically net income plus non-cash items. So if you know what EBITDA is, EBITDA times 3 to 3.5 is a very general rule of thumb on what a business valuation comes out at and would be expected to come out at. I hope that helps. Again, as Ian said, it varies quite a bit from industry to industry. All that is a general rule of thumb and general guidance, not set in stone by any stretch.
Got you. Can you provide the name of the banks that you are represent again?
Yes, Sandy Spring Bank. It's right there at the top of that slide there.
Okay. Is there a set format forms available for a business plan that would be acceptable?
Is there a set of format? So let me see here. I would say really the biggest standard form here, whenever I'm going back. So a personal financial statement, every bank has a different version of the personal financial statement. Outside of that, if you guys are using QuickBooks for your financials, that format's fine. If you guys are running it yourself on Excel, I've seen everything under the sun as far as it comes to financial reporting. So that's sort of open-ended.
And I would say, I would add to that on business plans, we see all types. We do have templates that we can share with borrowers. You can find these on the internet as well. There's no, again, right way or wrong way. You want a pretty comprehensive information in the business plan, again, that demonstrates the borrower's business acumen and, if it's got projections, assumptions that go with that. But we can provide some basic templates there to assist with starting that process.
Thank you. I think this one for you, John. A construction contract may have a 150-day performance schedule. So does the SBA have a loan that supports a construction project? And is the funding time 30 to 45 days?
Yeah, that's a great question. We do provide construction loans often in the SBA space. We typically, and I don't know if this is going to answer that question specifically, but just at a high level, we typically vet the GC depending on the size of the project. We want to make sure that GC has adequate experience and adequate financial wherewithal. As anybody who's been through a construction project before knows, the worst case scenario is the GC quitting halfway through the project. And then you're like, what do we do now? Right. So we do some vetting of the GC. We typically use AIA forms, 30-day draws. For loans of a certain size, typically $1 million or more, we'll use third-party construction monitoring firms to validate that the amount being requested is mirrors the amount of work that's been completed. Again, probably get into the weeds a little bit, but construction loans are common in the SBA space. He or she mentioned some specific timelines, and I don't know if I addressed their concerns around that, but happy to answer more specifically if they want to circle back on that.
Thank you, John. What are the most effective funding options for a national wellness brand seeking capital for retail expansion, product development, and purchase order financing?
Yeah, and this is where it comes into, I said most of this, everything I was going to talk about was sort of general rules. It would depend on the situation. So if you have capital yourself already in the bank, if you got a few $100,000 in deposits that you've been building up, some of that's going to be, the owner injecting it into the company itself to support that expansion. If you have cash flow that could support it, that can support maybe a line of credit to help you guys open up some new retail stores, then that could apply. Again, it really it comes down to how strong the cash flow is, whether you might have some collateral to inject into it and to support the loan itself. And then again, what the actual plan itself is. Again, we take that into account as well.
Thank you, Ian. Are there any geographical restrictions as far as lending? Somebody said they're in Missouri.
For me, it would, yes. So we only lend in DC, Maryland, and Virginia. That will likely be changing this year as we're going through an acquisition. But as of now, yes, we only do DC, Maryland, Virginia. John, I think you've got a larger one though.
Yeah, as I mentioned before, we do lend nationally on the SBA side and look at opportunities throughout the country.
Thank you, guys. If we already have an EDIL loan that we are paying off, will that affect our possible approval of an additional SBA loan?
Yeah, it's a very good question. I appreciate that person asking it. It does not impact your ability to get an SBA loan. As you can imagine, we have a lot of borrowers that have an EIDL loan in place. The process typically is for us to reach out to the SBA and have that EIDL loan subordinated to ours. They do that easily and quickly. That's not a big deal. So it's doesn't impact your ability to secure an SBA loan, and it's an easy process.
Thank you. What is the SBA guarantee amount? 100% is the question.
Yeah, so good question. So the SBA provides guarantees to banks that participate in the loan program to incent them to take on riskier credits. On the 7(a) term loan, the government provides a 75% loss guarantee to the banks that participate in the loan program. On the express line of credit, that guarantee is a 50% guarantee. On the 504 loan program, it doesn't have a government guarantee, but the structure of the loan is such that the bank's portion of the loan is only at 50% of the total. So it's a lower loan to value percentage, which is an easier credit consideration for the bank. So those are the kinds of considerations and details around that question.
Thank you. We are wrapping up to the end. I am a minority female disabled veteran small business in a rural area owner. I would like to expand my business as well as eventually start a second location. Who would you suggest I contact first to at least start the addition project?
Yeah, well, congrats on expansion. That's always an exciting time. I think the folks you would have in your business circle. So whether that's your accountant, maybe you have an attorney. I would say if you used a real estate agent to open your first location, talking to them about potential second spots may be the case. Once you have some of those things lined up, then you can, chat with the bank if you need some additional financing and building that space out to help the expansion. But most of the time, banks are brought into the loop after all the details and all the sort of logistics behind the project itself are figured out. Because again, they're going to want to have a real big picture idea of what you're trying to do.
Thank you.
Mhm.
Can you talk to the government lock opportunity? I think it's called borrow-based lock. Y'all familiar with that borrow-based lock? What are the
Yeah, borrowing
requirements
based
for
line
the
of credit.
owner?
So, again, this is, I would say, of all the borrowing bases I've done, I would say almost 100% of them have been to government contractors. So, essentially, what you see there is, unfortunately, I think there's a little bit of a slower turnaround time with government funding companies, with some of these defense contracts or IT contracts, software contracts. So, let's say a government contracting firm has $1 million in receivables from the government. The bank, we would provide 90% of that accounts receivable, so 900,000, in a line of credit, and that would be made to support the government contractor while they wait for payment from the deliverables. So if it's a 2-year project, they're starting this month, but they're not going to receive the first payment from the government for 3 months or whatever it may be. The line of credit based off of those accounts receivable can provide some interim financing, so you can either expand staff as needed, cover payroll, buy some new materials, whatever it may be.
Awesome. Thank you. And just to wrap up, only 2 more questions. Do you offer specialized loans or programs for minority, veteran, or women-owned small businesses?
I will say we like them. I don't know that they're particularly specialized. Again, this is a little bit less. We have less promotions, less fixed rates. Everything's sort of case by case dependent. So, having that support with veterans is definitely a big focus for us. And one of the things, we are a community bank here in DC, so we look at the community aspect and where the company's located, what they've done. So yeah, it definitely certainly comes into effect. But as far as a specific promotional item, not necessarily.
And on the SBA side, those individual groups do not receive any benefit from a underwriting and approval perspective. Periodically, the SBA will offer discounted closing costs to certain groups. There are not any of those available currently, but historically, veteran-owned businesses have received discounts on SBA closing costs associated with SBA loan programs. But again, currently those discounts are not available.
Thank you. And 2 more questions. How does your bank assess the credit worthiness of a small business? Is personal credit a major factor?
Everything. So again, that's part of that initial financial package is first off, at least for me. So again, I have an analysis background. So I would always look at cash flow first. That was always the first thing for me when whatever, work with operating companies. Second thing's collateral. Again, sometimes there will be some collateral down, but the personal guarantor is a very big part of it. And depending on the situation, depending on how key you are to that business, it can be a very big deal. Some companies have a detailed succession plan in place. If an owner is getting ready to retire, we take that into consideration. But certainly, because, at the end of the day, a personal guarantee is, hey, if this company, worst case scenario, goes under and does not survive, what does the person supporting that company have to try and repay this debt? So it is definitely a heavy part of our analysis.
And I would add to that on the SBA side, despite the government guarantee, we do look at all those considerations in detail. On the personal side, question that often arises is, will a previous bankruptcy jeopardize my ability to get a loan? As Ian has answered consistently, it's very much on a case-by-case basis. How long ago was it? What were the reasons and results of that? We do look at a personal financial statement. We do look at personal credit scores. We do look at both liquidity and post-injection liquidity. These are all what we call elements of a kind of a personal report card. Have you been responsible personally with how you tend to your personal matters? Do you have savings accounts? Have you kept a clean record, a good credit score? Those are very important considerations for SBA loans as well as conventional loans.
Awesome. Thank you. John, somebody wanted to know, could they reach out to you to have some information that they want to share with you for that financial inspection? Would that be okay? So I just put your information back up here. I don't think you wonder if it's okay for them to contact you.
Absolutely. Please do. Yep.
Awesome. Well, that's all the questions for today. I appreciate you guys' time. This was some great information. I hope all the participants, really receive something out of it, and definitely contact, Shady Spring Bank and their team. If you guys need anything, contact me if you need anything as well on the small business side. So I thank you. I hope everybody have a wonderful holiday. Happy holidays once again. Everybody be safe and enjoy family and friends. And definitely after this over, let us know how we did today. Please fill out the survey. Please take your time with it. The first thing you will see is strongly disagree. However, if you do strongly disagree, it's okay if you put that. But if not, just let us know how we did today. And I hope like I said, see you guys next time. Have a wonderful day. I see the guys sharing their information in the chat with their email, so please feel free to reach out to them. Talk to you guys soon. Thank you.
Thank you.
Yeah. Everybody.
Thank you, team. This was great. Appreciate you guys.
Absolutely. Appreciate it, guys.